All right, this is going to be the second to last live stream of 2024, and this is going to be the last Federal Reserve meeting of 2024. So my sound sounds pretty good, and it's good to have you guys. But anyway, welcome to the special live stream session. And man, am I super fired up to talk about the Federal Reserve's decision today with an interest rate cut in less than 30 minutes at 11 a.m. Pacific Standard Time or 2 p.m. Eastern Standard Time. And as always, I have my favorite channel, Bloomberg, ready to go. And this is also being live streamed in my private group. So if you're interested in joining my private group, you can visit firesidechat.com/community. Jerome Powell is also going to have a press conference at 11:30 a.m. or 2:30 p.m. Eastern Standard Time. And we definitely want to hear what Jerome Powell has to say about today's decision to cut rates by 25 basis points and how the Fed is moving forward at the next meeting on January 29th, which is 9 days after Trump takes over the White House. And we're also going to get the latest summary of economic projections or SCP so that we can get an outlook of 2025 about how many times the Fed is looking to cut interest rates throughout the year. And if you're watching this on replay, I'll be sure to leave chapters in this video so that you can navigate your way around the live stream. Okay. Now, this is interesting, and I want to show you a little bit of drama here because let me bring this over so I can switch the screen. Oh, I can't switch the screen. That's weird. Yeah, oh well. I can't switch the screen, but let me go ahead and switch this anyway. So there was a little bit of drama at the last Fed meeting when the reporters asked Jerome Powell if he would resign if Trump asked him to. But Trump recently took a step back by stating in last week's interview that he will not try to replace Federal Reserve's Chair Jerome Powell upon taking office in January. And this was on NBC News, and Trump replied to the question if he would seek to remove Jerome Powell, and he replied, no, I don't think so. I don't see it. So I think it's safe to say that that piece of drama is over at this time until Jerome Powell is done with his term in 2026. Are we going to have a new chairman? Quite possibly. But keep in mind that this was not the first time Trump tried to dismiss Jerome Powell, and it happened back in 2018 when the Federal Reserve out of nowhere decided to raise interest rates, and Trump publicly criticized Jerome Powell while he was the sitting president. And he criticized Powell again in early 2020 during the beginning of the COVID-19 pandemic that he made several bad decisions. And Trump has also argued about the independence of the Federal Reserve and that the president of the United States should have a say in the decision-making process of the Fed. And we'll see how everything unfolds in 2025 when he takes over the White House on January 20th. And I don't know if you guys are keeping track of what's going on with the in the news recently, but the government again is looking to shut down if they don't pass this short-term funding bill before Friday, and the deadline is on Friday, December 20th. And the measure Congress just released will keep the government funded until March 14th. But Congress is basically scrambling to get this short-term bill finalized before Friday. So as of right now, we still have the Republican-controlled House, but the Democrats still control the Senate, and the White House. Joe Biden is still in the White House until January 20th. And when President-elect Trump officially takes over on January 20th, then the things are going to be different. But I honestly don't know why Congress keeps doing these last-minute things, and it's like they're the master procrastinators with everything they do. But with the funding expiring on Friday, it's not a good look on Congress, especially with the holidays approaching. And it's all about the optics, right? It's not about who's in control, but if the GOP doesn't do this correctly, then they're going to end up getting blamed in 2025, even though right now the Democrats are in control of the Senate and the White House. It's a Game of Thrones, really. And if you really look at it from that perspective, and I haven't had the chance to read this 1,500-page funding bill, but it has everything from the environment, foreign affairs, veterans affairs, and cybersecurity. So what might have to happen is that they pass this short-term funding bill, and then when the GOP takes over the White House, Senate, and the House, they're going to try to pass another maybe long-term bill, hopefully, because they're going to need to discuss the debt ceiling as well. And we'll see how that goes. And I'll keep you guys posted on in the private community. But anyway, Um, the market right now is currently predicting a 25 basis point rate cut today. And we're looking to end 2024 with Fed funds rate between 4.25 to 4.5%. And we're also going to get the latest SEP or summary of economic projections today to get a better outlook for 2025. And I've been saying this in every public live stream that if the jobs report keeps coming in weaker than expected, then I wouldn't be surprised if the Fed keeps cutting rates by another 25 basis points, one meeting at a time. I don't think they're going to do any emergency rate cuts because we're not seeing the unemployment rate jump as much. However, the Fed can continue to cut rates, and they're probably not going to stop until they reach a certain point. So don't be surprised if the Fed funds rates drop below, maybe below by 3% by the end of 2025. And the next Federal Reserve meeting or the FOMC meeting after today is going to be on January 29th, which is 9 days after Inauguration Day on January 20th. Now that we know that Trump is not going to try to remove Jerome Powell, it'll be interesting to see how Trump will react to every Fed decision in 2025. And the prediction right now is to pause the interest rate cut, but we saw this with the December meeting as well, and even November. And I wouldn't be surprised if the Fed decides to cut rates again if the labor market continues to cool down or if there's a significant weakness in the jobs market. So we'll see how that goes. Okay. So now here are some things that I want you to pay attention to starting today until the next Federal Reserve meeting on January 29th. So if you're especially looking to borrow money in 2025 because you're looking to buy a house, starting a business, or expanding your business, I strongly encourage you to mark your calendar or make sure to get your notifications by subscribing to this channel. Or you can join my private community at firestation.com/community. And I'm actually looking to take out a mortgage in 2025 because, yes, I am moving and getting a new office around the summer of 2025. So I'll keep you guys, posted and maybe even do a tour around the new office. But anyway, tomorrow morning, we're going to have the third and final estimate of the Q3 GDP to find out if we're going to see any changes of 3% from the first two estimates. And the Q4 GDP will be interesting because US companies have been importing at the highest volume of goods and services since Trump got elected in early November because he has been talking about imposing tariffs for a while now, right? So having a higher inventory does directly affect the GDP because inventory is considered a component within the GDP calculation. So US businesses with higher inventory levels generally contribute positively to our GDP, while lower inventory levels negatively impact our GDP. And we're not going to get the first estimate for the Q4 GDP until January 25th. And on Friday, we're going to get the PCE inflation, which is something that the Fed pays attention to. And the next one is on January 27th, which is 2 days before the next Federal Reserve meeting. So we're going to get two PCE inflation reports between today and January 29th. And unemployment is what we're still paying attention to it. So we're going to pay attention to this on January 10th. And that's going to give us the overall unemployment rate for the calendar year 2024. And we're also going to get the JOLTS on January 7th. And if you're just now tuning in, JOLTS stands for the jobs opening or the job openings and labor turnover survey, which helps gauge labor demand, while the unemployment rate that I just mentioned measures the supply side of the labor market. So the JOLTS report will give us a better indicator of a solid or maybe a weak labor market, right? And we're going to have the next inflation data or PPI or producer price index on January 14th and CPI or consumer price index on January 15th. And so don't be surprised if the interest rates at your bank start to go down before the next Fed meeting if we're all predicting the Fed to cut interest rates on January 29th. And retail sales report will come out on January 16th. And that's going to be interesting because we'll find out how we did during the holiday shopping season. And then all eyes are going to be on January 20th when Trump takes over the White House and other elected officials take office in Congress. And as soon as he takes office, I'm going to pay attention to the executive orders he's going to implement and rescind on the day or the day after he takes office. And the Fed will meet 9 days after the transition of power is complete. And this is the SCP from the September FOMC meeting. In about 20 minutes, we're going to get is it 20 minutes? We're going to get the latest version of the SCP, which stands for Summary of Economic Projections, so that we have a better idea of how many times the Fed is looking to cut rates in 2025. And we get this report 4 times a year in December, March, June, and September. And this is what I want to pay attention to. And this is the range for the federal funds rate throughout 2025. And after the Fed cuts rates today, it's going to be at 4.25 to 4.5%. And from the September report, they're predicting 125 basis point rate cuts from 4.25 to potentially 3% when I round it up from 2.9%. And there are 8 Federal Reserve meetings in 2025. So if the new SCP, I shouldn't say if, when the new SCP comes out and keeps the Fed funds rates, let's say 2.9 to 4.1%, then we're probably going to see a total of 5 rate cuts if they just cut 25 basis points at each meeting. So that's going to be 5 out of 8 meetings they'll cut interest rates. So we'll see about that. And Jerome Powell did state that he wants to gradually cut rates without triggering inflation again. So we'll see what happens when the report comes out in about 17 minutes. And this is the unemployment projection. And as you can see at the bottom of the September SCP, it predicted a 4.2%. I'm sorry, that was from June. So from June, it was a 4.2% in 2025. But the September report showed a 4.4%. And the unemployment rate that came out from the month of November increased from 4.1% to 4.2%. And we won't know the unemployment rate for December 2024 until the report comes out on January 10th. And if it continues to increase, the Federal Reserve will look to cut rates even more aggressively throughout 2025. And that's my prediction. And can the median Fed funds rate get below the previous projection at 3.4%? It's hard to tell at this time, but I wouldn't be surprised if it's lower to 3% if the range changes from 2.9% to 4.1% to 2.5 to 3.5%. And I want you to keep in mind that the data will almost always change every time the SCP comes out. So remember, these projections are based on how each member of the Federal Reserve feels about the future of our economy. They can easily change their minds if the future data comes in much stronger or maybe weaker than expected. And take a look at the Fed's dot plot. And the newest version will come out today in the Summary of Economic Projections, or SCP. And those dots, or not these dots that I'm showing you right now, came from the September SCP that reflect what each U.S. central banker thinks will be the appropriate midpoint of the Fed funds rate by the end of every calendar year. So the new one will show the 2025, 26, 27, and 28 projections. And we're going to get this in March, June, September, and December, or 4 times a year, right? And now the dot plot has 19 individual projections, and they're all kept anonymous. So no one knows which official or governor is which dot. And the dot plot was created in 2012 when the economy was just recovering from the Great Recession to show a form of guidance for the Federal Reserve. And you also don't want to look at the 2026 dot plots too seriously because they will change every quarter depending on the economic data that we receive in between these quarters. And the last dot plots from September show that a majority of the Fed officials were looking to maintain the Fed funds rates between 3 and 3.5% by the end of 2025. And when the new one comes out, I'm going to put it right next to this chart. So you're going to get to see the comparison between those two. And I'm going to guess that most Fed officials then will move their dot plots to where the green box is showing right now at between 2.5 to 3.5%. And that's just my guesstimate, okay? And that's going to show a positive rate cut for almost every meeting. I'm sorry, not positive, a possible rate cut for almost every meeting they'll have in 2025. So remember, they're going to have 8 meetings in 2025. So if they go from 4.25 to 4.5% to 2.5 to 2.75%, that's going to be 7 rate cuts with 25 basis points for the 8 meetings they'll have. It probably makes sense for the Fed to pause the interest rate cut in January, but it's going to depend on several data points like unemployment, jolts, PC inflation, and the GDP. And this could become a reality if the jobs report just keeps coming in weaker than expected, right? And the labor market is going to be the complete focus today at the press conference. Well, I'm sure people are going to ask Jerome Powell questions about how the Fed is going to adjust its monetary policy when Congress changes its fiscal policy and how they're going to work with, President-elect Trump and all that. But anyway, the Bureau of Labor Statistics showed there were 7.74 million jobs open at the end at the end of October, which was an increase from the 7.37 million we saw in September. Job openings in September have been at their lowest level since January 2021. The jolts for September was also revised downwards from the 7.44 million jobs that were originally reported to 7.37 million. That's a significant change right here. That's what it says. And don't be surprised if we get more revisions in the future jolts. So I'll keep you guys posted. And the Feds are also paying attention to the hiring rates in the US, which fell from 3.5 to 3.3%. It is much more difficult to find a job today than it was in 2021 and 2022. The JOLTS showed 5.31 million hires made at the end of October, down from the 5.58 million hires made during September. And what's also interesting is that there was a rise in quits in the month of October, which is a positive sign for consumer sentiments that the labor market might be getting better with more job openings going into 2025. And I like to see a trend instead of just a single report, so that the JOLTS report on January 7th could give us more indications of a positive trend, right? And the non-farm payrolls came out much higher than expected, and with 227,000 jobs for the month compared to the Dow Jones consensus estimate of 214,000. But the unemployment rate did increase from 4.1 to 4.2%. September's payroll count was also revised upward to 255,000, which is up 32,000 from the prior estimate. And if you remember, in my previous live stream in November, October's jobs number was held back by impacts from Hurricane Milton and the Boeing strike. And the unemployment rate increased from 4.1% to 4.2% as expected. The jobless figure rose as the labor force participation rate lowered from the previous month. And this data and the JOLTS alone are likely, or more than likely, to give the Federal Reserve today the green light to lower interest rates by 25 basis points. And what's also interesting is that in this holiday season, some stores are holding off on hiring seasonal workers, and the retail trade saw a pretty big decline of 28,000 jobs last month heading into the holiday season. And the next unemployment report comes out on January 10th, which will give us a better idea of how the stores did in the holiday shopping season. And I think more shoppers are choosing to shop for holiday gifts online than ever before. And the need for retail stores during the holiday season has been declining over the years. I don't know about you guys, but I rarely have the need to go to the physical store in person to buy anything. So instead, I just go online to buy things that I need, knowing that they're going to be in stock, right? And the survey of households to calculate the unemployment rate also showed a significant decline of 355,000 in a month, even as the labor force contracted by 193,000. So keep in mind that the labor force participation rate measures the share of the working age population either at work or looking for a job. So that participation rate declined by 0.1% to 62.5% for the month. And the full-time job holders also decreased by 111,000, while part-time workers were off by 268,000. Wow, right? And this is where all the jobs went in November 2024. Over 72,000 jobs went to the healthcare sector as more baby boomers continue to retire from the workforce and aging in the population. But keep in mind that these 72,000 jobs are part of the 79,000 jobs added in private education and health services lumped together in the same category for some reason. Leisure and hospitality was another big category with over 53,000 jobs added in the month of November, which was the second biggest contribution to the non-farm payrolls for the month. And the government sector at the local, state, and federal levels came in much weaker than the previous month. And it had a big decline from 38,000 jobs to 33,000 jobs in the month of November. And this is worth keeping an eye on with the incoming Trump administration and Doge and how they're going to start cutting government jobs to make the government more efficient with their spending. So we'll see how that goes. And the professional and business services sector was a big surprise to me because last month in October, we saw a big loss of 23,000 jobs. And now it's gained 26,000 jobs in November. And this could be because Trump won the election and Trump has a record of taking a more deregulation approach to the banking and investing sector. And several investment banks are already hiring more people in preparation for mergers and acquisitions without going through red tape or interference from the Justice Department. And I'm pretty bullish on the banking sector going into 2025. And I talked about that recently in my private group that there are several stocks worth keeping an eye on. Now, the recent employment data could be a trend in the right direction, but it's worth keeping an eye on the weakening sectors like retail trade, which went from a loss of 3,000 jobs in the previous month to a loss of 28,000 jobs in the month of November. And we'll see how it looks on January 10th when the new unemployment data comes out. So be sure to subscribe if you haven't done it already, and it's free, okay? And the latest PCE inflation, is that it? Nope. So I don't have the data. Oh, wow. Okay. So the latest PC inflation came out just a day before Thanksgiving, and we're going to get the latest one on Friday for the November data, but it's going to be a few days after the Fed had already met. And if you don't know what the PCE price index is, it's the personal consumption expenditures price index that measures the prices that people pay for goods and services. While CPI, I talk about a lot, CPI is consumer price index, and that measures more items that are not included in the PCE inflation. And that's why CPI tends to show more inflation than the PCE. But anyway, the PCE price index increased by 0.2% on the month and showed a 12-month inflation rate of 2.3%. And they were both in line with expectations. However, core PCE inflation came in stronger with a 0.3% increase on a monthly basis and an annual reading of 2.8%. And personal spending also increased by 0.4% on the month, and personal income also jumped by 0.6%. But for the month of November, don't be surprised if the PCE inflation goes up from something like 2.3% to 2.5 or 2.6%, because people do tend to spend more money during the holiday season. And does this mean high inflation is back? Not necessarily. It could just be a temporary thing when people are just stopping for the holidays or stop shopping for the holidays. Oh man, I can't talk today. Now, let me talk about the stock market because it has been another incredible year. If you started investing in the S&P 500 at the beginning of 2023, you would have made about a 55% return in the last 2 years. Does that mean that it's going to do another 55% in the next 2 years? No, but it just further proves every good investor's theory that as long as you dollar cost average your investments, you're going to come out on top. And I also get this question a lot. And that's what I think the S&P 500 will be in 2025 with the new administration, Congress, and the potential tariffs being imposed on foreign goods. I don't know why people ask me that. It's not like I'm the oracle or something, right? But let me show you what everybody else is saying on Wall Street is saying about the S&P 500 prediction by the end of 2025. And then I'm going to give you my thoughts on it. Okay, so take a look at this. Oppenheimer is the most bullish investment firm with an S&P 500 target of 7,100 by the end of 2025, and followed by Wells Fargo at 7,007. I don't know why they added a 7, but I think they just did it to be more bullish than the rest of them. Yardini Research is a firm that I follow pretty closely, and they're also bullish with 7,000, and the rest of them are around 6,500. So if the S&P 500 finishes with 6,100 by the end of 2024, A 6,500 finish will be about a 6% return. A 6,800 finish, that would be around a 10 to 11% return. And a 7,100 finish would be about a 15% return. I would actually agree with Oppenheimer and Gardini Research that it should finish around 7,000, if not more. That's just my prediction. Because if you look at, I don't know if this is going to show all the stocks here. If you look at all the stocks that are inside the S&P 500, I don't think Nvidia is done growing yet, and I'm seeing a lot more growth potential just from their computer chips, hardware, and software systems for artificial intelligence. I don't quite see Apple and Microsoft growing as much in 2025, but I can see a significant growth potential from Amazon, Meta, Tesla, Broadcom, and Google. And if those stocks continue to beat the top and the revenue, the top line really mainly during all the quarterly earnings, the S&P 500 index fund will just go right along with them. And I know some of you guys are saying that about the stock market in general, that it is way too expensive to get in. But guys, I've been hearing the same thing every single year since I started investing in 2005. And when I truly started investing for FIRE in 2016, after I paid off my debt in 2015, the S&P 500 back then was at 2,000 points. And people told me back then that it was too expensive. Boy, am I glad that I didn't listen to them, because look at where it is now. And you're always going to have, you're always going to experience some type of market drawback from time to time, because if you look at the S&P 500 chart here for this entire year of 2024, there have been several instances when the market dipped by 2 to 3%. What did I do? I bought more with a 3% discount. When the market was down by 20% in 2022, what did I do? I bought more stocks with a 20% discount. And when it comes to my retirement accounts, like my 401k or Roth IRA, I never timed the market. I just let the market do all the work for me, and you don't lose money until you actually sell it at a loss, right? And the people who missed out are the ones who became fearful and cashed out of their investments because they thought a global depression was coming to them or something like that. Just ride with the market and see what happens, okay? So in about 1 minute, they're going to announce the interest rate decision. So what I'm going to do is I'm going to show you guys Bloomberg.
Say, TK, I'm pleased you brought this up. How Mar-a-Lago responds to this in the minutes and hours after this decision, I think will be pretty interesting.
Especially because it's a two-part act there. On one hand, let's go. Let's get the engines revving up. On the other hand,
let's go.
Inflation's the reason why Joe Biden lost. That's what a lot of people believe.
I spent 20 minutes before this using the Bloomberg. I even got to Hungarian forint. John, I know your place in Budapest, you cared about that.
Last year, I think down double digits against the dollar.
Yeah, for separate reasons, it really popped.
Welcome to the channel membership. I'm Turn the Aviator.
Welcome back, TK.
Kevin
I've missed
Zach.
these conversations.
I'm Saul. Why not? It's a nice name. Crypto Alex.
Do you remember those Swiss franc mortgages all those years ago?
Yeah, the Swissy foreign mortgages.
Who would have thought we'd be talking about this 50 seconds out from the decision? But that was a real thing. That was a problem in the day.
Actually, right now, there are nodes of that happening in different places. I mean, check out what's going on in Brazil.
Let's hope that Brazilians haven't been taking Swiss franc mortgages, because they've probably been in a lot of trouble after the performance of that currency this year. Let's turn to the scores. That decision is 30 seconds away. Equities on the S&P 500 positive by 0.2% on the S&P. Some outperformance so far this afternoon on the Russell. The small caps up by 0.65%. If you switch up the board and get to the bond market story, check out the yield curve. We'll slice this up on the 2s, the 10s, the 30s. Yields are coming down at the front end of the curve by about 3 basis points to 421.30. On a 10-year, we're down a single basis point to 438.29. With your Federal Reserve decision, the overwhelming consensus saying a 25 basis point cut. Here's Mike
head of Bloomberg.
It is a 25 basis point cut, and the number of cuts forecast for next year has been cut in half to just 2. Another 2 are seen in 2026 and 1 in 2027. And as the long-run Fed funds rate expectation rises to 3%. If that's basically seen as Fed officials' view of the neutral rate, they won't get there under this dot plot until 2028. We have one dissent. New Cleveland Fed President Beth Hammond Economic casts her first, preferring to leave rates unchanged. Interestingly, 3 other members of the committee, presumably non-voters, agreed with her. 10 members see two cuts next year. 5 see 3 or more. 3 forecast 1. And there's 1 member who thinks optimal policy would be to leave rates unchanged all of 2026 and 25. There is only one change to the statement. They now promise to carefully assess incoming data, quote, in considering the extent and timing of additional adjustments to the target range for the federal funds rate. There's no change to the committee's view of inflation, which has, quote, made progress toward the committee's 2% objective, but remains somewhat elevated. The new economic forecasts, however, show both PCE headline and core inflation forecasts revised up significantly. Headline will be 2.5% at the end of next year, up from 2.1 forecast in September. The core also 2.5%, up from 2.2%. They do see unemployment at 4.3% at the end of next year, which is down 1/10 from September. The economy will end this year with GDP up 2.5%. That's a 0.5 percentage point jump from their September outlook, and it is going to grow 2.1% in 2026, a significant slowdown. In one technical note, the Fed did lower the offering rate for overnight reverse repurchase agreements by 30 basis points to 4.25%. That's the same as the Fed's target range lower bound. Guys?
Mike McKee, thank you, sir. There's so much to unpack here. So let's just go with 2025 and go to the forecast. So we get a 25 basis point cut. And then they do this for 2025. GDP revised higher. Unemployment revised just a little bit lower. Then go to PCE. Once again, revised just that little bit higher. So what do you get for the dot plot? The median dot was actually pointing towards 4 cuts for 2025. They've cut that in half to 2. Which basically marks the whole thing to market. This is where the market was, looking for 2 cuts in 2025, and this is what the Fed is projecting, if you consider this a projection in the median dot. Turning to the price action off the back of this, we unlock another dose of dollar strength. Euro dollar breaking down to 104.44 off the back of that move in the bond market, with yields higher at the front end of the curve on a 2-year up by 3 basis points to 428, on a 10-year up by a single basis point to 441. In the equity market off the back of that, we come off session highs. On the S&P 500, we are just about unchanged. So if you are just joining us, welcome to the program. It's a 25 basis point reduction from the Federal Reserve with a sprinkle of dissent and some big changes, Lisa, to the forecast.
The market's not liking that.
And what you can see is basically the market readjusting, but not necessarily freaking out. I think it's fascinating, the idea that Beth Hammack, the new Cleveland Fed president, is the lone dissenter. 3 non-voting members, as Michael McKee said, seem to have agreed with her. To me, this is the definition of a hawkish cut. We now have 100 basis points of rate cuts since that September meeting. Now they seem to be only baking in 2 rate cuts, as you said, and it raises a question of what the parameters are, what the messaging will be from Fed Chair Jay Powell.
Compare the September
that's pretty
forecast to the
hawkish. I'm
forecast
looking
we
at the
just
2
got.
rate cuts
Where
for
they thought Fed
2025.
funds would be at the end of next year is now where they think Fed funds will be at the end of 2026. They've pushed the whole thing out 12 months. Now, the debate we're going to have, and no doubt the debate they'll have in the news conference with Chairman Powell and the journalists, how much of this is about realized data, the data we've had since the September meeting, and how much of this is about assuming, speculating, guessing what's about to happen with policy?
Well, and ultimately, how much can they divorce the two if they're looking for signals from the collective betting agency, the collective wisdom of the crowds of markets? At a certain point, they have been following the market in certain aspects.
Okay, I'm going to pause that for a second. I'm going to show you the dot plots that they're talking about right now, and I'm going to show you the summary of economic projections. So, oh man, this is going to be it's going to be one of those days, huh? It's not going to make it easy for anybody here. So, there we go. Okay, so I put 2 and 2 together. If you start the live stream from the beginning, so on the left side here, that was the what they had projected by the end of 2025, that most members or governors of the Federal Reserve were looking at between between 3 and 4%. So on the right side, as you can see, most of them are staying above 3.5%, and that's what the market is reacting to right now. And it's between 3.5 and 4% right now. So that's, remember, this is by the end of the year, not at the beginning of the year, but by the end of the year. Now, is this going to remain where it's at? No, not necessarily. And it's going to change every quarter. And so the next one that's going to come out is going to be in March, and the one after that in June, and then September, and then December. So we'll see how that goes. But right now, as you can see, there one member remained at about at 4.25%, between 4 and 4.25. That's the range there. And now it's 3 members, and then there's an extra member who is becoming more hawkish by maintaining the rate cuts at where it is at 4.25 to 4.5%. I can't wait to see the reaction from Trump there. But right now, and there's no change for the 3 members going into the 3.5 to 3.75. But right now, from the overall consensus, is that they're projecting 2 rate cuts down to 3.75 to 4%. So right now we're at 4.25 to 4.5%. Yeah, that's actually did not expect that. I was thinking it would be much lower over here between 3 and 4%. Now, let me show you what's in the actual economic projection here. Okay, here we go. And if you can't see this because the screen is too slow, you can go ahead and pinch on your whatever device that you're watching it, and then you can zoom in on that data. So I'm gonna try not to zoom in so that you guys can feel free to do that. Okay. So when you read this, remember at the bottom, I'm gonna go ahead and zoom in one. I'm sorry, I can't see it, so I'm gonna have to zoom in on that. All right. So at the bottom here, this is from the September meeting. So for 2024, they had a real GDP stopping at 2%, and then now they're predicting at 2.5%. And now the GDP for 2025, it's revised up to from 2% to 2.1%. And don't really look at 26 or 27, but take a look at the unemployment rate. They're projecting that the unemployment rate will go down from 4.4 to 4.3. I'm sorry, 4.2 to 4.3%. And this is pretty given because we already got the report on that. So that we're getting 4.2%, and now they're thinking that it's going to be about a 4.3% median for next year. And PC inflation going from 2.4. Well, this is a big revision here. They're really predicting that the inflation is going to trend back up from 2.1 to 2.5. We're probably finishing this year around 2.4%. And they think it's going to go back up to 2.5%. And we're going to listen to what what Jerome Powell has to say about the, how he feels about all of this and why they made a decision on going 2.5 as opposed to 2.1. And core PCE also rose from 2.2 to 2.5%. And the one thing I wanted to pay attention to was here. So yeah, it looks like it went from 2.9 to 4.1. Now it went back up to 3.1 to 4.4. So wow, this is a very hawkish report that I did not see coming. So interesting. And I can't wait till 11:30, which is in 20 minutes, that Jerome Powell is going to speak to the press to kind of give us an idea of how they came up with these numbers for 2025. It matters to me. You're probably sitting there wondering why it matters to anybody. It's, people want to borrow money to expand their businesses. They want to buy rental properties. They want to get a house, and mortgages has been a problem too. Like people are not buying houses because the mortgage rates are still at 6.5%. But anyway, let's look at the Fed funds rate median is going to be about 3.9%. So that's a 50 basis point increase. Not what I had in mind when I started this live stream. If you rewind back about 30 minutes ago, I said, I'm expecting this to probably come down to about 3%. But now that's not happening until 2026 and 2027. So that could mean that we're going to see a higher interest rate going forward in 2025. And what does that mean for the house, right? And people are kind of like on the sideline waiting for the mortgage rates to drop. And remember, that has nothing to do with the Fed funds rates. They're, following the 10-year treasury yield. But with the uncertainty of what inflation is going to do in 2025 with all the tariffs being imposed on foreign goods, how that's going to affect the consumers and how they're going to start buying things at a higher price possibly. So that's something that that's worth paying attention to. Now, kind of want to see what they're going to say, but yeah, so just to read you guys on what the Federal Reserve said, and this is something that Jerome Powell is going to say exactly at the press conference, is recent indicators. You know what? Let me go and switch the screen here so you guys can read this. Here we go. So recent indicators suggest that economic activity has continued to expand at a solid pace. Since earlier in the year, labor market conditions have generally eased and the unemployment rate has moved up but remains low. Inflation has made progress towards the committee's 2% objective, but remains somewhat elevated. That's exactly what Jerome Powell is going to say at the beginning of the press conference anyway. So you can probably skip that part. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. The committee judges that the risks to achieving its employment and inflation goals are roughly in balance. The economic outlook is uncertain, and the committee is attentive to the risks to both sides of its dual mandate. Okay. Same thing as the last one. So in support of its goals, the committee decided to lower the target. It's now down to 4.25 to 4.5%. So this is basically the official statement from the Federal Reserve. And you're going to hear the same thing at the press conference. And what I'm really looking forward to is what they're going to say during the meeting on, when people start asking questions like, okay, so what was the thought process on going from 3.9% to 4.1%, right? So let's listen to Bloomberg real quick and see what they have to say, because I want to catch my breath here. And I'm kind of like disappointed in myself with the not predicting correctly. Man, a little bit of a surprise here, huh? With this news, are you updating your TSP? No, I think I'm gonna keep it where it is. I think I like it the way it is with the, how I have allocated with my TSP. And, TSP is not my only retirement account that I have from my prior service, but, my 401k, I am definitely becoming more bullish on the small and some medium cap stocks that are worth paying attention to. Those are the things that I'm kind of like, okay, these have been pretty weak for a while. The banking sector, right? Maybe the energy, we'll see. But with the new administration coming, I am paying attention to what these small businesses will do better under the Trump administration, because it's been very expensive to run a business, and I run a business too. The fireside chat business with my clients, and running a YouTube channel and all that. The operating expenses have definitely increased over the last 2 years. And, if they're going to, make things cheaper, I think that they're probably going to start with taxes. And, how that's going to benefit small businesses, we'll have to wait and see how that goes. Okay. Good question, though.
Some of the employment markets that Diane was talking about. Do you agree?
Ooh, the market hates it.
I think the bar was low. It got a lot higher because they're telling us they're rethinking how many cuts they have to do. And certainly by the time they...
And just real quick about the projection, the next FOMC meeting on January 29th. Yeah, as of right now, I don't think they're going to cut rates for the next meeting. The data has to show us that the labor market is like a lot weaker than expected. And we're just not seeing that right now. And how much, Trump can do to influence the Fed, I don't think, not much, right? So
here and now. The risk is now that the economy slows and the Fed is passively tightening by doing nothing. And here's the kicker, I think the punchline. Curious that the Fed was about to cut 100 basis points and then all of a sudden stops as Trump walks through the door. Diane, how much of these moves, the change to the forecast that we're seeing, are about the incoming data since September, and how much of it is about expected changes to policy that will shape that data in the years to come?
Well, we do know that with the continuing resolution that they're talking about a fairly large increase in bailout funds for the affected states from the 2 hurricanes. That will boost growth at the beginning of the year, and it is inflationary at the same time. So that is sort of already baked into the cake. Are they doing scenarios? Of course they are, but they can couch, certainly, I think you're going to see Powell couch very much and be very cautious to say they're not front running any policy. They did cut at this meeting. If they were front running policy, they wouldn't have cut at this meeting. And I think that's what Powell wanted to say, even with a dissent, with this hawkish tone. This is sort of the perfect way for him to say, we're doing our job. We're looking at the data. It's coming in stronger. The economy's solid, and it justifies higher rates. Now, you always worry about what's going to break going forward. The administration coming in, they will have more information on it. But even tariffs take quite a while to kick in. They don't kick in overnight. And I think people forget about that. And we don't know what, not only will the tariffs completely look like, we have ideas and we can model out scenarios, but retaliation will be designed to disrupt supply chains. That's very important, because when you're thinking about it that way, that is inflationary. And we're in a much more fragile supply chain environment, which we've already seen. Vehicle prices have already gone up again, just in response to the damages and the buying ahead of additional price hikes due to 2 monster hurricanes. So we're in a situation where we have much more fragile supply chains with the embers of inflation still smoldering. That's just not a situation you want to add fuel to the fire on. You want to keep the lid on inflation. And I think the Fed is still hoping to hit that soft landing. But a soft landing, really, they will not declare victory. And this will not be Chairman Powell that we saw a year ago, who was pretty jubilant a year ago when we were sitting in this exact spot. I think you're going to see a Chairman Powell that is cautious, optimistic about the economy, talking about the strength of the economy. That's why they're doing what they're doing. That's why the outlook looks like it is, not front-running policy.
Michael, I got a 10-year yield moving, the real yield. The real yield was a 2.05, 2.02. All of a sudden, I'm popping 4 basis points, rounded up out to 2.13%. What does that signal to your bond market? What does that signal to business, just to see the real yield buttressed up right against recent highs back 6 months?
It tells me that investors might have been tilted the wrong way coming into the FOMC decision, and they're unwinding some of that. We'll see where it closes. I'm pretty optimistic things will settle down. I think Diane said it correctly, that this is still a Fed that cut rates in front of incoming policies. So they must see something in the improvement in inflation that they like, and they must see something in the labor market that they want to make sure doesn't metastasize.
We'll find out more in about 11 minutes' time when this news conference starts. A special thanks to Dan Swank of KPMG. I want to draw your attention to what's developing in the FX market and elsewhere. So we'll start in the bond market. Just a flavour of that. Yields up on the front end by 7 basis points. The 2-year back through 430. If you take that move, just push it through foreign exchange. What do you expect? Big moves in G10. The dollar stronger against absolutely everything against the majors in G10. Beyond that in EM, Tom, 2% move against Brazil.
2 against a -6. Well,
that's another 2%.
Each of them, but each of them are idiosyncratic.
On top of the 20 so far this year.
Yes, you got Turkish lira popping through 35 today, finally, but they're each a different.
Yeah, I mean, they were, they're saying that, well, the investors are not panicking just yet. I mean, this report came out pretty hawkish, right? And it's basically telling all the investors and pretty much, the whole country that, hey, we're not looking to cut rates much in 2025. If anything, it'll just be 2 rate cuts of 25 or 0.25% at a time in 2025. And that's going to be, I want to see if Trump has tweeted or said anything in Truth Social, but, this is going to be, that's going to be probably going to be a concern for the incoming Trump administration and say, well, this is what we're doing. The new policies are being implemented. Probably not going to work if the rate cuts are not happening as much. And that's that's a conflict that the new administration and the Fed will have. But knowing how Jerome Powell, what he said in the previous press conference, I don't think he's going to budge in and say, "Oh yeah, I'm going to do what Trump says." Kind of felt like that in 2018. When they raised interest rates at the end of the year, and then they cut rates again in 2018, and that's when we're all like, is the Fed just doing what the administration is doing? But it was a weird interest rate. Like, they raised it out of nowhere. Like, we didn't see any data indication saying that they needed to raise interest rates. Inflation was fine. And, when they cut rates, we're like, all right, never mind on that. And 2019 had a really, really good growth, right? Does that mean that we're going to have a recession and all that? Not necessarily. But we could see more weaknesses in certain sectors. We could see the labor market just continues to trend downwards, maybe in certain sectors. Maybe right now we're in the cooling period where the tech sector, they have been cutting more people because they're using more artificial intelligence. But what does that mean for the service industry and all that? There's been talks about, well, we can't hire enough people, and the new administration is looking to, not bringing in as many people into this country. Maybe, he hasn't really talked about legal immigration, but if he's going to deport illegal immigrants in the country, then where does that go with the labor force? How is that going to impact the people in the maybe in the rural industry, maybe like in the farming industry and all that? That's really yet to see how that's going to play out. And if they say that we don't have enough people to hire, then a lot more businesses and companies are going to rely more on artificial intelligence. And I'll be honest with you, I have start using more AI this year than ever before, because there's so many tools that help me edit videos, publish videos on their own. And, that's going to cut the labor costs by probably about 30 to 40%. I have my own P&L statement every single quarter, and I look at it, I'm like, wow, the profit's going up. And I'm not, I'm not a public company. I'm not trying to sell my company to you, but I'm just saying that when I look at my quarterly top line and bottom line, and I see my revenue going up and I see the net profit also going up, that's a good sign, because I cut costs for maybe someone who used to publish my videos or edit my videos, and now I don't need them anymore, and I can just cut the operating expenses and pay itself back into the business to expand on something else or something like that. But I could see for someone, a small business like me doing this, just imagine the other small, medium, and large businesses looking at, do we need to hire this many people anymore? Maybe we don't need to. Maybe we can just use more AI to get the 20 tasks that used to require 2 employees to get done, and now it's going to be just maybe 5 employees, and now it's just 1 employee overseeing the overall management of the tasks that they need to do. So we'll see how that goes. And I think there's going to be probably some weaknesses in certain sectors. I just don't know what yet. I don't want to say it here in a public forum, because there can be so many possibilities. So anyway, Jerome Powell should be speaking in about 5 minutes, and I'm just going to leave Bloomberg alone here. Before I turn that on, I'm going to be live streaming on the last day of the year, December 31st, and I'm going to do a little bit of a portfolio review of how my index funds and ETFs have performed. But just remember, I would never give out financial advice on my channel, and it's just kind of like showing my FIRE progress. If you're just, if you've been following me for a while, it's about financial independence and retire early, where I am. I have achieved a few milestones this year, me and my wife, and this is something really worth celebrating about. But really, we're pretty optimistic about 2025 and where this is going. And the channel has grown pretty tremendously. So appreciate all of your support for sure.
Conditions have eased, sentiment has improved. So I do think this economy has substantial momentum behind it, and I think can give you strong growth outcomes. One thing I'm a little bit surprised about is actually their potential growth estimate remained at 1.8%. They've been talking so much about productivity growth, the supply side of the economy. I thought that would begin to manifest in a higher potential growth rate in their forecasts. Didn't happen today, but maybe that's in the coming quarters.
Matt, what would you want to ask Jay Powell at a time when everyone's going to try to get him to comment on Trump policies and everyone's going to try to understand just how high the bar is to cut again?
Yeah, so I think, I was going to ask about kind of the level of restriction if they had 3 cuts baked in. But I think it's more about understanding how they're thinking about a few things in the labor market. Bob mentioned, some weakness in the labor market. I'd be interested in whether or not the rise in the unemployment today, they would view similarly to the rise through the summer. I think there's many reasons for them not to. Payroll gains are stronger. The quits rate has moved higher. The hiring rate has stabilized a little bit. Job openings have picked up. But are they as concerned about this rise in the unemployment rate as they were during the summer? Second question, I think, is on shelter inflation. We did have this big downdraft in the latest print that went against Chair Powell, saying that there's going to be a very slow progress on this front.
So Jerome Powell should be coming on in less than 3 minutes. I don't know if you guys saw this, but it looks like the Supreme Court is going to look at TikTok potential ban. If you're following this, the appeals court upheld that the U.S. has the right to ban TikTok over national security concerns. I'll be honest with you. I have a TikTok account, a business account. I rarely go on it. I probably once a month because all the content that's being published on there is all on automatic publish. It'll be interesting to see how this is gonna make people react to it. And who benefits more from that, right? Meta, who owns Instagram, and as well as Google, YouTube. People are probably gonna end up watching more YouTube Shorts in the future. And I'm monetized with TikTok too, but they don't pay as much. I noticed. I had several videos that had like probably pretty close to 1 million views, and it's really it's interesting how this could become a permanent ban. And TikTok is arguing that it's unconstitutional because it's an infringement on free speech. So when TikTok is still owned by China, national security concern is there. And if you read all the government workers are now allowed to have a TikTok app on their phones. I mean, I don't really carry it away, really. I don't really go on TikTok. Let me know in the chat if you guys go on TikTok. Yeah.
Are still around 2.25% to 2.6%. I don't read anything into it more than that.
So basically, do you think that at this point, this is a Federal Reserve that basically really is just throwing darts at a dartboard?
I think they have to be because they don't.
Well, that's essentially what he's saying. But carry on.
They don't know what. By the way, back in 2009, they would have forecast 2.25% to 2.5%.
And the mortgage rates will end up probably staying at about 6% if they only cut rates by like maybe twice. I would say probably going to be between 5.5 to 6% at best. And what that means is that people are probably going to have to. The buyers are just going to have to, accept the fact that the mortgage rates are going to remain high because, at the end, the longer you wait, you end up just kind of missing out on the home prices for the year, right? Because if people tell you that the home prices will crash, I don't see that happening. I just don't see home prices crashing anytime soon.
The holidays after this is like kind of it for many of you I know going into year end, for us included. Physically, I've said we'll be here, but sort of psychologically we'll be somewhere else.
Okay, you keep saying
after we
this.
wrap up this news conference.
So you want me to still come in tomorrow?
I'm going to be here. You're going to be here.
Are you going to be here? Or
TK's going to be somewhat checked out.
You're actually going to get to go off.
No, TK's not here physically either, right?
Yeah,
You're done.
I didn't take a vacation day until the Red Sox were eliminated. Okay, that's my tradition. So that got me to May 10th.
Nice.
And so thank you. So, I'm taking a couple days off. I'll be here next week to pick up the pieces.
There he
The
goes.
chairman's
There he
here
is.
right now, so we should probably cross over down to Washington, D.C. and catch up with the chairman of the Federal Reserve, Jay Powell, after reducing interest rates by 25 basis points.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market, while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Here comes the questions.
Gina Smialik with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals: maximum employment and price stability. We see the risks as two-sided: moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut. And I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation,
if it cools too much, it's not a good thing.
Still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
I told you he was going to say
Sorry,
that.
just one quick follow up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
Okay.
Howard Schneider with Reuters, and thanks for the opportunity to ask you a question. So this does seem similar to the dynamic in 2016 during the last transition to a Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year, that inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since, so what's really driving the slower rate cut path? First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people. The way I would say it is this: some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. The point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down. And so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
If I could follow up on that, you mentioned the risk and uncertainty indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation, September and October. As I mentioned, November is back on track. But once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still, going to be.
I was trying to look for what Trump has said, anything about the rate cuts today. I'm not seeing anything from Trump's reaction or anything from the Trump's team, but they are talking about Canada, the 51st state. I need to read up on that and see what that's about.
That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, we're going to want to be seeing further progress on bringing inflation down and keeping a solid labor market.
Chris.
Thank you, Chris Rugaber at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal Book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal Book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point. And I would just say, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And, there were two simulations. One was seeing through, one was not. And I'd point there's some language in the see-through paragraph that says, it considers situations in which it might be appropriate to see through inflation, and then name some conditions in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding, again, the ways in which tariff-driven inflation can affect tariffs can affect inflation in the economy, and how to think about that. So we've done a good bit of work. All of us have, each of us has, and it puts us in position when we finally do see what the actual policies are to make a more careful, thoughtful assessment of what might be the appropriate policy response.
Great. And just a quick follow. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many, many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all.
Just so you know, I just noticed this. I am live streaming this through StreamYard, and YouTube is filtering comments like crazy, and that is not by my settings. So if you don't see the live chat going on, it's YouTube is doing something to filter those words out, and I'm not seeing any bad words or anything like that. Someone said something about Biden, and that got cut out. I mean, come on, YouTube, you don't need to cut that out. There's nothing bad about it, but it's just not showing up on the YouTube live chat. I just noticed that, and I'm like, man, I have more stuff going on in my live chat and on StreamYard than I do on YouTube, because the filter, I should say, I don't know if it's filter or censorship. I don't know
how they're implemented, and we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
Nick Timros of the Wall Street Journal. Chair Powell,
Hey,
to make
here we
sure I
go. I
understand,
like
participants today revised up their core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers. So we have inflation coming down, core inflation coming down to 2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but that would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling so far in an orderly, gradual way. But it's also something we need to keep our eye on.
I guess if I could follow up, if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to infer that?
So that's not any decision that we made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points. So it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests, again, that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run. We're trying to make sensible policy as we go. And I just would emphasize the uncertainty, which is it's just a function of the fact that we expect significant policy changes. There's nothing really unusual about that. I think we need to see what they are and see what the effects they will have. We'll have a much clearer picture, I think, when that happens.
Michael McKee from Bloomberg Radio and Television. Even though you've cut rates by 100 basis points this year, we haven't seen much change in mortgages, auto loan rates, or credit card rates. You say you're significantly restrictive. Are you running a risk that the markets are fighting against you and the economy could be more at risk of a slowdown than you anticipate?
The rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that, but we look at all financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So we're now well into another year of growth that looks like it might be 2.5%. Second and third quarters were right about at the same level. So the U.S. economy is just performing very, very well, substantially better than our global peer group. And there's no reason to think a downturn is any more likely than it usually is. So the outlook is pretty bright for our economy. We have to stay on task, though, and continue to have restrictive policies so that we can get inflation down to 2%. We're also going to be looking out for the labor market. We want to keep the labor market pretty close to where it is. We're pretty close to estimates of the natural rate of unemployment. Job creation is a little below the level that would keep it there, but nonetheless close. And so that's what our policy is trying to achieve.
If I could follow up by asking about your formulation for beginning rate cuts, included the phrase, we need to have confidence that inflation is moving down towards our target. Given the fact that you've raised your forecast for next year, do you have confidence, or are you uncertain about the path of inflation going forward?
So confidence was our test for raising rates. And, we've made, look at the broader sweep. We've made just a great deal of progress. We're well into the twos in core inflation, and around 2.5 or even lower than that we have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. You do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought, 2 years ago. But it's nonetheless steadily coming down as market rents, start to equilibrate better with, new leases that turn over, not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. A good example is financial services, which is really done off of asset prices. And that's how that inflation works. So the overall picture, the story of why inflation should be coming down, is still intact. In particular, the labor market. Look at the labor market. It is cooler by so many measures now, modestly cooler than it was in 2019, a year when inflation was well under 2%. So it's not a source of inflationary pressures. Not to say there aren't regional and particular professions where labor is tight. But overall, you're not getting inflationary impulses of any significance from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22 in, for example, housing services, and now also in insurance in particular, where costs went up, and those are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to get down to 2%. It might take another year or two from here, but I'm confident that that's the path we're on. And, our policy will do everything it can to assure that that is the case.
Colby.
Thank you. Colby Smith with the Financial Times. So the unemployment rate as of November, while still very low, is within spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to the 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on that front, or is it just about there being more upside risk to inflation that now needs to be accounted for?
The unemployment rate is now the same as it was in July, 4.2%. It's moved up and down, but it's now the same as July. And job creation is lower than it has been, but it's been steady. It's not declining. It's steady at a level which, as I pointed out a couple of times, is actually below the level that would hold the unemployment rate constant, but it's not so far below. So you might, if we have the break-even level right, and if job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually,
mortgage rates are going up.
That kind of precision in this. So you're right, though, and I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or in a way that really raises concerns. I think, you pointed out, participants in the FOMC really thought that the risks and uncertainty had improved relative to the labor market. And it's because things have just gotten a little bit better. It doesn't, the unemployment rate flat and things like that. Nonetheless, we're watching it closely.
If the idea, though, is that no additional kind of softening in the labor market is welcome here, what's to prevent that from happening if rates are still restrictive?
So what I said is we don't think we need further softening to get to 2% inflation. That's what I'm saying. Not that it's not welcome. We don't need it, we don't think. If you had a situation where inflation is moving around by 1/10 every few months, that's, we'd have to weigh that against the fact that inflation has in recent months been moving sideways in the 12-month window. And so we've got to weigh them both. And at this point, for a while there, we were only really focused, mainly focused on inflation. We've now gotten to a place where the risks of the two we think are broadly, roughly in balance. And so that's how we think about it.
Steve.
Mr. Chairman, I did not hear you use the word recalibration today. And I'm just wondering if the recalibration phase is over and what you might call this new phase and whether the criteria for changing rates is somehow different and higher than it was before. Thanks.
We're not renaming the phase yet, but we may get around to that. But no, I would say we are, though, in a new phase in the process, as I said. So, and that's just because we've reduced our policy rate by 100 basis points. We're significantly closer to neutral. We still think where we are is meaningfully restrictive. And I think from this point forward, it's appropriate to move cautiously and look for progress on inflation. We've done a lot to support economic activity by cutting 100 basis points. And that's a good thing. I support the decision, and I think it was the right decision to make. I think from now, we are in a place where the risks really are in balance, and we need to see progress on inflation. And that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
Wonder if I could follow up and ask you how much you or the committee are looking through some of the high numbers we've had in the recent inflation numbers. For example, cars being up maybe because of the hurricanes, eggs because of the avian flu, that kind of stuff, and then looking forward perhaps to housing inflation coming down as it did in the recent report.
So we always try to be careful about not throwing out the numbers we don't like. It's just an occupational hazard is to look, those high months are wrong. What about the low months? We have a very low month potentially in November. It's estimated by many to be in the mid-teens for core PCE. So that could be idiosyncratically low. We try to look at not just a couple or 3 months. We shouldn't have our position shouldn't change based on 2 or 3 months of good or bad data. We have a long string now of inflation coming down gradually over time. As I mentioned, 12-month, I think it's 12-month headlines, 2.5, 12-month core is 2.8. That's way better than we were. We still have some work to do, though, is how we're looking at it. And we need policy to remain restrictive to get that work done, we think.
Okay.
Neil.
Thanks, Chair. Chair Powell. Neil Irwin from Axios. Financial markets have been very buoyant really all year. Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully at financial conditions. Of course, that's part of what we do. But we really look carefully at is the performance of our goal variables and how are we affecting the economy. So what we've seen over the course of just take the last year. We've seen inflation, over the last couple of years, come down a lot. We've seen the labor market cool off quite a bit. That suggests that our policy is restrictive. We can also look more directly at the parts of the economy that are affected by that are interest sensitive, like particularly housing. Housing activity is very low. And that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want. A lot of things move financial conditions around, as you know. and we don't really control those. But I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefits in the U.S. government building a reserve of Bitcoin?
Ooh. So, we're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
Andrew.
Hey, happy holidays, Mr. Chairman. Thanks for taking our questions. I was wondering if you are satisfied with the way 2024 is ending, if you're confident that we've avoided the recession that forecasters were predicting as inevitable a couple years ago.
I think it's pretty clear we've avoided a recession. I think growth this year has been solid. It really has. PDFP, private domestic final purchases, which we think is the best indicator of private demand, is looking to come in around 3% this year. This is a really good number. Again, the U.S. economy has just been remarkable, and it's when in these international meetings that I attend, this has been the story, is that how well the U.S. is doing. And if you look around the world, there's just a lot of slow growth and continuous struggles with inflation. I feel very good about where the economy is and the performance of the economy, and we want to keep that going.
The other thing I just wanted to ask about was the you guys have noted that the unemployment rate is still low. However, employment rates have fallen rather quickly. The prime age employment rate has fell by about half a point.
Yes.
0.5% rather recently. The question, I guess, is do you think there's maybe more downside momentum in the labor market than the unemployment rate alone is signaling?
I don't think so. No, I think overall, if you look at it, prime age participation is still very high. What's going on in the labor market is that the hiring rate is low. So if you have a job, you're doing very well, and layoffs are very low, right? So people are not losing their jobs in large numbers, unusually large numbers. If you are looking for a job, though, the hiring rate is low, and that's a signal of lower demand. It has come down. So we look for signs like that, and that's clearly a sign of softening, further softening. I didn't mention it earlier,
said that
but
in this live stream.
I think you can see an ongoing gradual softening in the labor market. Again, not something we need to see to get 2% inflation, and that's part of the reason that explains why we moved ahead today with the action with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high. Wages are at a healthy and ever more sustainable level, wage growth. And so the labor market, this is a good labor market, and we want to keep it that way.
Thanks.
Amira.
Thank you, Amara Mokway from Bloomberg News. I just want to put a finer point on the labor market. Can you keep the labor market this way in the strong position that you have described without further cuts? In other words, do you still view the labor market as needing support to protect against the further cooling?
We can't know that with any tremendous certainty. I will say that we think that our policy balances the risks. We think the risks are roughly in balance as between the two mandates. And we think the labor market is in solid shape. And when I say it's softening or cooling, it's a very gradual process. Job creations are meaningfully positive. Wages are, if anything, still a bit above what would be sustainable if productivity were to revert to its longer run trend. If you take into account the high productivity readings we've had, then wages are already at a sustainable level relative to 2% inflation. So I don't want to overstate the downside in the labor market because the downsides clearly appear to have diminished. Nonetheless, it's one of our mandate goals, and we pay close attention to it. And it's worth noting that it is still gradually cooling, and in an orderly way. And that's how I would characterize it, and that's why we're paying careful attention.
Elizabeth. Thanks so much, Chair Powell. Elizabeth Schulze from ABC News. As you've noted, the Fed is now forecasting higher inflation next year. High prices are still a burden for so many households right now. Why do you think it is that inflation is proving to be more stubborn than you'd expected?
You know, it breaks down into a long answer if you want, but it just has been a little bit more stubborn. I think if you go back 2 or 3 years, many people were saying that to get this far down, we would have had to had a deep recession and, you know, high unemployment by now. Well, that has not been the case. So, you know, the path down has actually been much better than many predicted. We've managed to have the unemployment rate remain essentially at its longer run natural rate, while inflation has come down from, you know, core PCE inflation has come down from 5.6% to 2.8% on a 12-month basis. So that's a pretty good outcome. Why hasn't it come down? One reason is that just a technical issue around the way we calculate housing services, and that process has been slower than market rents are showing up more slowly in that measure than we might have thought 2 years ago. So that's part of it. I think there are other parts of the story, but you know, what I think people are feeling right now is the effect of high prices, not high inflation. So we understand very well that prices went up by a great deal, and people really feel that. And it's prices of food and transportation and heating your home and things like that. So there's tremendous pain in that burst of inflation that was very global. This was everywhere in all the advanced economies at the same time. So now we have inflation itself is way down, but people are still feeling high prices. And that is really what people are feeling. The best we can do for them, and that's who we work for, is to get inflation back down to its target and keep it there so that people are earning, you know, big real wage increases so that their wages are going up. Their compensation is going up faster than inflation year upon year upon year. And that's what will restore people's good feeling about the economy. That's what it will take, and that's what we're aiming for.
And as we look ahead to next year, what do you see as the biggest challenge to the economy under the next administration?
I feel very good about where the economy is. Honestly, I'm very optimistic about the economy, and it's we're in a really good place. Our policy's in a really good place. I expect another good year next year.
Edward.
With that said, I'm going to buy some stocks.
Thanks, Chair Powell.
The market is down.
Edward Lawrence from Fox Business. So you say that we're closer to the neutral rate. What percent do you see, and the committee believes, where is that neutral rate?
So I'll say a couple of things. First of all, when we write, the thing we write down in the summary of economic projections is the longer run neutral rate, which is the neutral rate at a time when supply and demand are in balance, the full economy is in balance, and no shocks are hitting the economy. That is not where we are right now. So when we're making monetary policy at the Fed, that's not the question we're asking. So you can't do a straight read between those longer run numbers that we write down and what we think the appropriate policy should be. So basically, at any given time, various shocks are hitting the economy. And so what we're doing in real time is we're looking at our policy stance, and we're looking at the way it's hitting the economy. And particularly, we look at the effects it's having as we try to move the economy toward maximum employment and price stability. And the answer can be, there are things that affect the economy that are lasting, but not permanent. And the ones that are permanent are the ones that would be in our star. The ones that could be lasting, but nonetheless go away over time, they could actually affect what's sort of technically the appropriate neutral stance in near term. So we're looking at that, and we don't know exactly where it is, but as I like to say, we know it by its works. And I think what we know for sure is that we're 100 basis points closer to it right now. There are many estimates of where that might be, and we know we're a lot closer to it. And I think we're in a good place, but I think from here, it's a new phase, and we're going to be, cautious about further cuts.
But I think that the markets are looking for a little more clarity. I mean, I've heard estimates from 2.9% to 4%. I think the markets would like to see a little more clarity about a year out, 18 months out, as to where that goalpost, for lack of a better term, is, because at the moment it looks big.
Yeah, I mean, honestly, there are countless models of what a neutral rate might be at any given time. There are empirical models, there are theoretical models, there are things that combine them, and they have as many different answers as you'd like. So there is no real certainty. And I mean, it's actually a good thing to know that we don't know exactly where it is. So you're not tempted to think, oh, I think this model or this estimate is right. You just have to be open to, the empirical data that are coming in and also how it's affecting the outlook. And it's not made any easier by the fact that, that our policy works with long and variable lags. Nonetheless, that is the job we have. And so I think it's appropriate for us now to proceed cautiously now that we're 100 basis points closer to neutral, and we'll do so. Meanwhile, the economy seems to be in good shape, and these cuts will certainly help to support economic activity and the labor market while we can still make progress on inflation because policy is still meaningfully restrictive.
Victoria. Hi, Victoria Guida with Politico. I just wanted to make sure I understood what you were saying at the beginning about inflation. Are you saying that progress on core PCE counts as progress on inflation, even if headline inflation ticks up? And then also, since that's what's projected in the SEP, I was wondering what accounts for that? Why do you all see core PCE going down and potentially headline inflation ticking up?
So, and as I imagine the goal overall is headline inflation because that's what people experience. People don't experience core inflation, they experience inflation, and that includes food and energy costs. So that's the overall goal. But as we know, headline inflation contains energy and food, and those prices can fluctuate for reasons that are not related to tightness in the economy and therefore are not really good predictors of future inflation. So it turns out that core inflation is a better predictor of overall inflation than overall inflation is. So we look at core inflation because it's a better measure of what future inflation is likely to be because it's a better measure of what inflation pressures exist. So it's complicated, but ultimately our goal is headline, not core. So your second question was what?
Why do you all see core going down, but headline potentially ticking up?
So headline can be affected. You're talking about next year.
Mm-hmm.
Yeah. So headline can be affected by energy prices and food prices. So that there will be things in the headline forecast that are to do with forecasts of energy prices, whereas core will be. If you look at core going out a full year, then it'll be much more driven by things like tightness in the economy. So that's why the two can go in different directions. Headline has been lower, as you know, most of this year. But that's because energy prices have been coming down, which is a great thing for people. But energy prices will come down and they will go up, and it won't really be telling us anything about how tight the economy is and how future inflation will perform.
Do geopolitical risks factor in at all to how you're thinking about energy
So
prices?
we monitor geopolitical risks really quickly, but really carefully rather. But I would say so far those risks nothing has come out of those risks that has really been important for the United States economy. The single thing that you would look to is the price of oil, given that we're talking about the Middle East and Ukraine, but that is a good summary statistic for the kind of thing that could go wrong with global turmoil. But the price of oil has been coming down, and because of global supply conditions. So the U.S. is not feeling really the effects of geopolitical turmoil, but we are certainly at a time of elevated geopolitical turmoil, and it remains a risk.
Kelly.
Thanks, Chair Powell. Kelly O'Grady from CBS News. I want to go back to something that you said a minute ago, that wage growth is outpacing inflation now. It wasn't the case for some time, of course. It's partly why Americans haven't felt much relief in their wallets from prices yet. But with inflation ticking up, how worried are you the progress in closing that gap could go away?
Yeah, so inflation, again, we don't react to a couple of months of higher readings or a couple of months of lower readings. And what we had was we had 4 months of really nice readings, and then September and October were higher, but then November is much lower. So I don't really think the public is experiencing that as a surprising upside risk to inflation. I think inflation is much lower. What the public is feeling, and they're right about it, is that prices are just, the price level went up because of the past inflation. And it's going to take some time for real wages to recover over a period of years in which your real compensation is growing. And in other words, your compensation is growing meaningfully faster than inflation. That's exactly the kind of economy we have now. And we just want to hold on to it. That process will probably take some years, but that's what's going on right now. And I don't think that a couple of months of higher inflation really signal that anything of the nature you're suggesting.
And just one follow-up, let's look more long-term. You previously predicted hitting the 2% inflation target in 2026. It's now been pushed out to 2027. You said you're focused on enabling further progress on inflation. That's not necessarily progress in the right direction. Are you confident that target isn't going to move further out?
We're talking about when you're projecting the economy, 3 years out, 2 years out, you're talking about high uncertainty. Very high uncertainty. We really, at that point, that's not possible to confidently predict where the economy is going to be in 3 years.
Yeah,
so
nobody knows.
As we're looking at what's happening now, we're kind of projecting that the same kinds of things are happening. So we keep a strong labor market. Housing services inflation comes down. Goods inflation settles down, and non-market services return to their prior level. All of those things should happen over time. And those pieces come together. There's every reason to think that they will. The timing of it is highly uncertain. But you're not wrong, though, that, it's been a bit frustrating because while we've made progress, it has been slower than we had hoped. Nonetheless, we're still on track. And, I think if two years ago you'd said we were at 4.2% unemployment and 2.8% inflation, people would say, "I'll take that." I mean, that's a pretty good interim place to be. Job's not done, but I think we're feeling good about where we are and where we're headed.
Go to Nancy for the last question.
Last question.
Hi, Chair Powell, Nancy Marshall-Genzer from Marketplace. You said a couple times inflation has been moving sideways, appears to be settling in around, 2.5%. Do you think the Fed is just going to have to settle for that and accept that you're not going to get to your 2% target?
No, we're not going to settle for that. I think we certainly have every intention and expectations that we'll get inflation back sustainably to 2%. That is, and I am confident we will achieve that. It has taken longer, but you have to be, we are making progress. We have made a great deal of progress, and we'll continue to do so and get back to 2% inflation. That's what we owe the public, and we're committed to achieving it.
In that case, can you rule out a rate hike next year?
You don't rule things completely in or out in this world. That doesn't appear to be a likely outcome. I think we're at 4.3%. That's meaningfully restrictive, and I think it's a well-calibrated rate for us to continue to make progress on inflation while keeping a strong labor market. So, thank you very much.
Okay. All right. So there we have it. And that was the end of his press conference. And just to kind of sum things up here, well, the 2025 is much more hawkish as far as interest rate cuts goes. So with the market being down, I actually bought some stocks, some index funds during the live stream. So that was the first time I did that in a while. I don't know if I've ever done it. But S&P 500 is down about 1.5%. Dow is down 500 points, and NASDAQ is down over 2%. So, and Russell 2000 down almost 3%. And it's something that I always want to take advantage of is, when the market is down, I'm like, "Ooh, let's go," right? If you watched it from the beginning of my live stream, almost 2 hours ago now, I said, when the market is down 3%, I'm going to treat it like this is a 3% discount today, right? And is it going to go up in the long term? Yeah. Is it going to go down even more after this? Who knows? Maybe it'll go right back up. But people are most people. I don't know. I shouldn't say most, right? But the majority of the people are optimistic about the economy going into 2025. New administration coming in, and Trump's been talking about tariffs, but then there's the tax cuts and Jobs Act expiring next year, and we're pretty optimistic that they're going to pass the 2.0. If you watch my video the other day about the U.S. getting a C+ on this retirement system, I actually wrote 2 separate emails to my senator and a House of Representative in Nevada. And I'll let you guys know if they do reply and let me know on the thoughts of my proposals to have that Secure Act 3.0 to improve the retirement system. We're kind of in a pickle about the Social Security, right? Nobody wants to talk about that Social Security right now because it doesn't become insolvent until the year 2033. So that's going to be after the administration, after Trump's administration. So that's like 8 years, 9 years down the road. So, if you know how the government works, they love to wait until the last minute to say, well, let's solve this later. Kind of like the government shutdown that's happening on Friday if they don't pass a short-term funding bill. But anyway, I really do appreciate all of you guys tuning in. And if you look at, the people who's been around, maybe from the beginning, really love watching this with you guys. And I do go live every time the Federal Reserve goes on makes decisions on the interest rates. And I also go live every other Wednesday to talk about any investment strategies, any retirement strategies they may have. You probably watch some of the Roth IRA and 401k and stuff like that. But, you can join me in the private community, firestatechat.com/community. And then we have the Fire Investing course. That's been pretty good so far. Good feedback. So I do appreciate you guys just continuously supporting my channel, my business, and the people who continue to work for me. And 2024 has been a tremendous year for me and my business. So really appreciate you guys. But anyway, the CME group right now for January, they're pricing in an 88.5% chance that they're going to keep the rates steady at 4.25 to 4.5%. I do tend to agree with that unless, okay, we see some weaknesses in the labor market. And, Jerome Powell did say it in the press conference that, it has been cooling, but if it cools more than it needs to, then that could be a trigger to cut interest rates. So we'll see about that. I know people feel like we're in a recession, but a recession is not a feeling; it is data driven. So if you read in the comment section, people say we're in a recession. Then there's the consumer sentiment, right? When 5 different people yell a recession or a fire, people are going to think that there is a recession. But just pay attention to the data. I am not 100%, trusting the some of the data they publish because there have been so many revisions. And I understand your doubts. Sometimes you're going to feel like, man, I don't know about this labor report. How did the unemployment rate go down after there have been more job losses in that month? That stuff like that. And I completely understand. But, this is why I share this. Now, you can also go to firestatechat.com/resources. There's the compound interest calculator. Fill out your name, and then you get your free resources on there. If you're a TSP investor, and on that resources website, you get to track your TSP funds, TSP prices for the year. And right now, the S&P 500 being down about 1.5%. I think we're going to finish with a 27% year-to-date return for the C fund, and then the S fund is obviously it's going to go down to about 19% return. But yeah, it's worth paying attention to. And just last announcement, I am going to be in New York in January, so that's going to be a little good time there. I am meeting with it is a business trip, and I'm meeting with clients and all that. So if you happen to be in New York, just let me know if you have any recommendations for a good pizza place. Man, I could kill some really good pizza right now. But again, I will be live streaming on December 31st, New Year's Eve, at the market close, and that's going to be the last stock market live stream for the year 2024, and I'm going to do a little bit of a portfolio review from there. So just watch out for that, and that's going to be about less than 2 weeks from today. No, about 2 weeks from today, right? No, that's 2 weeks from yesterday. So looking forward to being in the live stream with you guys, and I may or may not be giving away some free courses as well. So, but anyway, appreciate you guys being here, and not entirely good news for everyone, but it is still I still feel optimistic. So stay tuned and subscribe if you haven't done it already. So anyway, with that being said, until next time.